Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The SP 500 has made a golden cross here as the 50-day moving average crosses above the 200-day moving average right here for the first time since July of 2020 here. That marked, of course, the beginning of this massive bull run that we've seen. You can see even price is retesting this breakout above the 200-day moving average as we speak. At the same time, you've got indicators like the panic euphoria model that is coming off very bearish, very extended levels here that we saw as the markets were bottoming here in October of 2022. Sentiment was the most bearish it's been since the COVID crash, before that 2015, before that 2009, and then the dot-com bear market. So it looks like this period of volatility that we've seen throughout 2022 is behind us. That momentum is coming back into the market and skies are clear from here. So we're going to actually dive into these indicators and reveal the truth behind them. Too many people right now are throwing these developments around without much data. So in this video, I want to show you the data. I'm going to show you what it means for the market. I'm going to try and stay as objective as possible. Of course, I'm going to give you my opinion here and there. Otherwise, it wouldn't be very fun. If you enjoy this video, don't forget to smash the like button as hard as you possibly can. Now, without further ado, let's get right into it. So let's start with the golden crosses on the S&P 500. This has corresponded in recent history. We zoom out here. In recent history, it has corresponded to a lot of very impressive rallies here. 2020, 2019, right here, March 2019, of course, marking the beginning of very strong momentum in the market. 2016, right here, again, marking the end of this period of volatility, marking the beginning of this bull run right here. So a lot of people are pointing to these examples right now and saying, okay, well, it's about just as simple as that. Momentum was negative back in March, and so that was bearish. And so now momentum is bullish and the bear market is behind us. Is it that simple? Well, we've run the numbers for you, and this is a chart highlighting all the instances where we had a golden cross going back to 1960. We could have gone back further, but this is already a very nice data set that basically takes into account the entire recent financial market history. This is the S&P 500, so you can very easily see what type of returns you get following these golden crosses. And just eyeballing this very quickly, you can see the red dots are the failed signals and the green dots are successful signals. There's just about as many red dots as green dots. Now this looks at returns 12 months after the signal. So you get the golden cross, the market does what it does for 12 months, and then you look at where the market is. That gives you an above average return around 50% of the time when you get a golden cross on the S&P 500. Now that we've done a lot of work on this, I would definitely say that the golden cross is an overhyped development that's often taken out of its context, and people can often cherry pick the right examples because indeed you can't get a recovery without a golden cross, but that doesn't mean they always lead to strong returns. I'm not here to sugarcoat. I want to give you the hard facts about these indicators so you are well equipped to make better decisions in the market. If you appreciate these types of insights, don't forget to hit the like button to help us grow our channel. It is really appreciated. Now let's focus on the panic euphoria model and understand if this bearish sentiment actually tells us anything about the market looking forward. Now, of course, more recently, we've been very bearish. We've seen a lot of people be very bearish. We've seen this indicator go into extreme zones. So just eyeballing this, you can see this actually did mark quite a few impressive bottoms. Right, 2015, 2018, you can argue that 2002 sentiment was extremely bearish, 1998 sentiment was extremely bearish. So if we backtest this indicator, look at how efficient it was throughout history, we can take a look at these 10 readings throughout history where you essentially had this indicator go below that zero line, that green line that you see. That's when indicator became very bearish. What did returns look like following that signal? Well, you can see out of 10 trades, 8 of them were positive. So yes, absolutely, the fact that sentiment is bearish generally means that forward returns are going to be better. Again, these are 12 months returns. That means that once this signal is triggered, you look at 12 months later, where's the stock market? Is it positive? Is it negative? 8 out of 10 times it was positive. And in fact, quite a few of these marked impressive bottoms like 2020 and 2019 here, and even 2015. Now, I do want to nuance this a little bit, because if we zoom in and look at a few of these examples in a little bit more detail, look at 2015 here. Yes, this signal was triggered here, but the market revisited that low. So there was still a lot of volatility around this period. Why did we have that volatility? Well, because the US economy was in a manufacturing recession back in 2015, 2016. So that created a lot of pressure on the stock market, a lot of downwards pressure as we had that weakness in the economy. This is a PMI survey that oscillates up and down. When it's below that 50 line, it means that we're in contraction, and that's exactly what was happening in 2015. So the fact that sentiment was bearish in this period didn't mean that the market just overlooked the macro environment. You continued to see a lot of volatility. Now, if we zoom out a little bit more, you can see these 3 more examples that we had in December of 2008 right here. Yes, it was close to the bottom, but you still had quite a bit of volatility right up until March of 2009. Again, if you look at this chart, that's because we actually saw economic weakness right up until March of 2009. The economy was still tanking leading up to March 2009. And so despite the fact that sentiment already got bearish in December, the market continued moving down because of macro. Now, just one more example. Look at this example of 2002. Right here in February of 2002, sentiment extremely bearish. It had already been very bearish since the end of 2001. You had a counter trend rally, and then the markets continued moving down later in 2022. Why did that happen? Well, surprise, surprise, economic activity remained in contraction territory throughout the better part of 2002, and so macro continued to be a drag on the markets in 2002, despite the fact that sentiment was very bearish. Yes, the fact that sentiment has been very bearish tends to mean that a lot of bad news has been discounted by market participants, but if we continue to see economic activity deteriorate in the months ahead, we have several examples throughout history where it doesn't matter if sentiment is bearish. If the macro is a headwind to the market will move down. If things are getting worse, the market will move down. And I wish that this wasn't the case. I wish I had better news to give you guys. I wish that we were heading into a bull market where we're going to see a lot of retail frenzy again. That's obviously something that a lot of viewers on this channel can agree is a better macro environment than a bear market. It's a lot easier to make money when things are going up, but that's just not the signal that we're getting right now from the bond market. That's telling us basically that we're at the end of this boom cycle, that unemployment is currently bottoming just like it did in these previous instances, 2006, 2000, 1989. And so to us, this is quite a high confidence call that you are going to see the unemployment start to rise, that you are going to see a hard landing as we get an economic contraction, as things get worse. How bad is it going to get? That's a whole entire discussion, a whole entire debate, and you can tune in for that on our website at gameoftrades.net. We are currently positioning our model portfolio to be protected against an environment where you have the unemployment rate rising, where economic activity is declining, people are losing their jobs. And so we want to help people protect their investments, protect their portfolios, and even ideally yield elevated returns during these periods, which is absolutely possible if you're invested in the right assets. We're gradually shifting our model portfolio allocation to something that will benefit from in an environment where economic activity is declining, where we're going from an environment where the unemployment rate is declining, where things are going well, where the economy is booming, to the very opposite, because it's binary. It's the boom and bust cycle. It's not the flat cycle. And we think we're at the end of the boom right now. Of course, let us know in the comments what you think. Don't forget to get your free trial by clicking on the link down below and checking out our website at gameoftrades.net. In the meantime, I wish you good luck on your trading and see you next time.